There's a family in America earning $19,000 a year. This year, the government is 5 times more likely to open an investigation into their taxes than into almost anyone else's. Not a billionaire. Not a hedge fund. Them. That isn't a mistake, and it isn't a conspiracy. It's a business decision. And once you see the math behind that decision, you'll understand why the cheapest person in America to investigate is probably you. Start with that 5, because it is not a figure of speech. At Syracuse University, there's a research project called TRAC that pries raw enforcement data out of federal agencies and publishes it. In one recent year, households earning under $25,000 were audited at a rate of about 13 returns for every 1,000 filed. Everyone earning above that line was audited at about 2.6 per 1,000. 13 against 2.6. That's the 5. It comes from the agency's own records. The official numbers say the same thing in a quieter voice. The research arm of Congress reports that in tax year 2019, the audit rate across every individual filer in the country was 0.29%. Call it 3 returns in 1,000. For people claiming the Earned Income Tax Credit, which is just a refund the government pays to people who work but don't earn much, the rate was 0.78%. Nearly 3 times the national average, pointed at the people with the least. So far, this looks like an outrage story. It isn't. It's an accounting story, and the accounting is far stranger than the outrage. Here's the first clue, and it's easy to miss. Between 2010 and 2019, the tax agency retreated from almost everybody. It lost staff, it lost budget, and audits fell across the board. But they didn't fall evenly. Audits of filers earning over $5 million dropped by 66%. Audits of filers earning under $25,000 dropped by 57%. Both fell. But think about what that gap actually tells you. When an organization runs out of money and has to decide what to stop doing, watch what it stops last. That is what it really values. The tax agency cut the rich end of its enforcement hardest and held on tightest to the cheap end. Why would an agency whose entire job is collecting money hold on to the people who don't have any? That question is the whole video. And the answer isn't cruelty or politics or some smoky room. It's a number, and it comes from the Government Accountability Office. Stay with it, because when that number lands, this stops being a story about fairness and starts being a story about your own file. First, you need to see the weapon. Because when you hear the word audit, you're probably picturing a person in a gray suit at your kitchen table, going through shoeboxes. That version barely exists anymore. In one recent year, the agency closed roughly 626,000 individual audits, and about 85% of them were what's called a correspondence audit. Correspondence just means mail. It's a letter. That's it. A letter is cheap. A letter doesn't need a badge, a car, a hotel room, or 4 years of a trained accountant's life. A letter is written once by a computer program, printed 100,000 times, and dropped in the mail. And for people claiming that low-income credit, the letter often arrives before the refund does. The money isn't taken back. It's simply held, sitting still, while a family tries to prove a child lived with them. Here's how much money that is. The average amount of that credit, nationwide, is about $2,743. For a household earning $19,000 a year, that's roughly 7 weeks of everything they make, frozen in place, waiting on a piece of paper. Not seized, not fined, just paused, indefinitely, while a machine waits for an answer. Now put yourself on the ladder, because this system treats you completely differently depending on which rung you're standing on, and almost nobody has ever seen the whole staircase. On the bottom rung, under $25,000, you get the letter. Automated, pre-refund, no human assigned to your name. The cost to run your case is close to nothing. In the middle, somewhere between $40,000 and $200,000, you're statistically the safest person in the country. Your income shows up on forms the government already has copies of, your deductions are boring, and there's almost nothing worth checking. Not because anyone likes you. Because there's no return on opening your file. Higher up, $200,000 and above, the letters start again, but now they're about specific line items. Business losses, rental property, charitable deductions that look a little athletic. And on the top rung, $5 million and up, there's no letter at all. There's a team. There are lawyers on both sides. There are partnerships inside partnerships, and the case can run for years before anyone agrees on a single number. Look at that staircase, and the obvious conclusion is that the agency has its priorities backwards. The money is at the top. Go get the money. So why doesn't it? Because that's not how any collection operation on Earth actually works, and this is where it helps to think like someone who runs one. Nobody who takes a cut for a living optimizes for the biggest score. They optimize for the surest one. A casino doesn't chase the whale who might win. It takes a small, certain slice of every hand at every table, all night, forever. The rake is boring on purpose. The whole business is built on volume, speed, and the near total absence of an argument. Now go back to that staircase. The man with $5 million and a legal team is the whale. He might pay. He might also spend 3 years and a fortune proving he owes nothing and walk away clean. The family earning $19,000 is the table. Small, certain, no argument. But before that lands, you deserve the strongest case against everything you've just heard, because it's a real one. The credit at the center of this genuinely is claimed wrong, a lot. In one recent year, the government estimated that about 24% of the money paid out under it, roughly $16 billion out of $68 billion, went out improperly. Not stolen, mostly. The rules about which adult gets to claim which child are genuinely confusing. Families move, custody shifts. But $16 billion is $16 billion, and Congress has leaned on the tax agency for decades to do something about it. So maybe none of this is a business decision at all. Maybe it's just enforcement pointed where the errors actually are. That's the honest counterargument. And it survives right up until you look at the one number nobody in this fight ever quotes. The Government Accountability Office measured what each type of audit produces per hour of an auditor's time. Not per case, per hour. And auditing people who claim that low-income credit brings in more additional tax per hour than auditing almost any other income group in America. The only ones who beat it are the very richest filers. Per hour of work, going after a family earning under $25,000 is about as productive for the Treasury as going after someone earning $5 to $10 million. Read that again, because it flips the entire story. The system is not more suspicious of poor people. It's just cheaper to be suspicious of them. Nobody sat in a room and decided to hunt the working poor. Somebody sat in a room and asked which cases return the most money per hour of staff time. And the answer that came back was the letter. Once you optimize an enforcement system for cost per case instead of dollars owed, it will walk itself down the income ladder every single time, without a single person intending it. And the reason it works so well at the bottom is the part that should genuinely bother you. The watchdog office inside the tax agency itself, the National Taxpayer Advocate, published what happens inside these cases. In one recent year, the agency closed nearly 260,000 audits of that credit. About 38% of them closed because the taxpayer never responded at all. Another 25% ended in a default, meaning the case was decided against them by silence. Only 3% of those people had anyone representing them. 3%. And when they called the audit helpline, fewer than half the calls reached a human being. Out of that entire year, 1,223 people took their case to tax court. Out of 260,000. That's not a compliance rate. That's an operation that wins by attrition, on paper, against people who can't afford a phone call. And it leaves a mark. A team of IRS researchers, including John Guyton and Dan Manoli, studied what happens to people after one of these letters. In the years afterward, audited taxpayers were less likely to claim the credit at all, less likely to file a tax return at all, even less likely to have reported wages showing up anywhere. Fewer claims, fewer returns, less visible income. The letter doesn't just collect. It teaches. You can see the shape of it on a map, too. Kim Bloomquist spent 2 decades as a senior economist inside the tax agency's own research division. After he left, he published an analysis showing that the most heavily audited county in the United States was Humphreys County, Mississippi, where the median household income is about $26,000. It was audited at a rate roughly 51% higher than Loudoun County, Virginia, which has the highest median household income in the country, around $130,000. The poorest county in the Delta audited half again as often as the richest county in America. Not because anyone chose it, because it was cheap. So here's what this means for your money. Right now, whatever rung you're on, your risk of hearing from the tax agency has almost nothing to do with how much you might owe. It has to do with how cheap you are to check. Every number on your return that also appears on a form somebody else already sent the government, your wages, your interest, your dividends, your payment app income, your brokerage sales, is verified by a computer for free. That's the rake. Those are the tables. That's where the letters come from. And they'll keep coming there because it costs almost nothing to send one. The complicated things, the ones that take a human being 3 years to unwind, are expensive. And expensive things get audited less. That's not a loophole anyone bought. It's just what happens when a collection operation is graded on cost per hour. If that reframe was useful, subscribe. This channel is for people who'd rather see how the machine sorts them than find out from an envelope. And the next one goes somewhere stranger, because there's a second system running quietly alongside this one, where the government already knows exactly what you owe, has known for months, and still makes you guess. Once you see why it does that, the letter starts to look like the polite part. One question before you go, and answer it in the comments, because the split is always interesting. Which is worse to you? A system that goes after the poorest people because someone decided to, or a system that does it because a spreadsheet said it was efficient and nobody had to decide anything at all? That family earning $19,000 a year was never the target. They were just the cheapest case on the desk. And the moment you can see the price tag sitting on your own file, you stop being the cheapest person in America to investigate.